because having a long-term investment horizon is the only way for the investors to get stable returns. In one of the books by Professor Jeremy Siegel, who examined the US equity history in the last 200 years, he showed that any short-term equity market return is highly volatile. In any one year in the history of US equity market, the market could return you as low as minus 40% or as high as plus 60%. In other words, if you have a very short investment horizon, your return will be highly random and depends on your luck. However, if you extend your investment horizon to more than 20 or 30 years, the variance will be much smaller. For any 30-year period in the US equity history, the range of investment return is between 2.6% and 10.6%. So as you can see here, for any investor holding a long-term investment horizon, they are more likely to get a more stable and predictable return. The second reason is that research and evidence show investors are very bad at making short-term investment decisions. For example, Dalbar, a US quantitative research lab, shows that most investors in the US have a horizon of 3 years in holding equity funds. And this is one of the reasons why their return always lags a passive S&P index fund, no matter how long you look back for the last 1, 2, 3, 5, or 20 years. Another study by Morningstar shows that back in 2012, investors in aggregate became bearish on equity market and pulled out from equity funds and poured into bond funds. In fact, in 2013, the next year, US equity went up 35% for the year, and the bonds went up 0.15%.